Welcome to today's Explainer, where we're going to turn market swings and volatility directly into your trading edge. If you know how to read the data, drawdowns actually signal opportunity. High volatility environments, they can literally become a trader's best friend. Today, we're dissecting a truly fascinating trading session. Oh, and by the way, we've got subtitles running right at the bottom of the screen, so you can easily follow along with all the numbers we're going to break down. Let's get into it. Okay, real quick before we dive in, let's cover the mandatory ground rules. This explainer is strictly for educational purposes, guys. Definitely not an investment recommendation. Always do your own research or consult with a financial expert before putting your money on the line. And just so you know, all the data we're looking at today is sourced directly from Zerota, the NSE, the BSC, and the MCX. So here's our roadmap for today. First, we'll hit the nifty roller coaster. Then we'll check out the sector and stock movers. After that, we'll dive into macro, money, and markets, run through corporate earnings and news, and finally wrap up with looking ahead.
All right, Section 1, the nifty roller coaster, focusing on intraday volatility and key levels. Let's start our story with today's main protagonist, the Nifty 50.
What an incredible tug of war today was. We kicked off with a really strong 101-point gap-up opening right out of the gate, hitting 24,097. Honestly, that showed some serious relative strength, especially considering global cues were pretty subdued. You could see this steady buying in that first hour, just climbing up and up, briefly testing that absolutely critical 24,300 zone right around 1 p.m. But then, bam, the momentum completely shifts. Sellers steadily took the wheel in the afternoon, drifting the index lower and slipping back below 24,200. It was basically a classic story, a strong opening rally, followed by some very deliberate, steady profit booking right into the close.
So here's the crucial takeaway. Even with that late-day profit booking in the afternoon slide, the Nifty still managed to rise 0.76% to close at 24,177.65. So what does that actually mean technically? Well, it means the index successfully reclaimed its 21-day exponential moving average after that dip we saw yesterday. Make no mistake, that is a vital technical victory for the bulls, even though the session felt pretty heavy towards the end.
Moving on to Section 2, Sector and Stock Movers, where we'll be peeling back the layers of the market. We know the headline index was up, but which specific sectors actually drove that price action? Well, the market breadth today was honestly a bit of a mixed bag. 8 out of the 12 major sectoral indices managed to close in the green, which sounds great, right? But if you look a little closer at the broader market participation, mid-caps actually slid 0.31%, lagging behind the large caps for the second day in a row. Small cap breadth also noticeably thinned out. So what this tells us is that while those headline numbers look nice and green, traders were being highly selective with their capital. And here's exactly where that selective capital went. We are seeing a real flight to safety right now. Defensive names completely led the charge today. FMCG was the undisputed top performer, up an impressive 1.75%, and Realty followed right behind at 1.48%. This was a stark contrast to the laggards today. Media slipped nearly 0.5%, and PSU banks dropped 0.41%. Whenever FMCG is leading the pack like this, it's a massive clue. It usually tells us that investors are actively hunting for safe harbors amidst all the uncertainty.
Okay, Section 3, Macro, Money, and Markets, the global forces at play. It is time to zoom out from our local indices for a minute and take a look at the broader global macroeconomic landscape that's shaping these moves.
We've got some major macroeconomic headwinds blowing against the market right now. The absolute biggest news here is the Indian rupee dropping to a record closing low of 94.85 against the US dollar. So why exactly is this happening? Well, it's being heavily pressured by stalled peace talks in Iran, combined with a massive surge in oil prices. You add in continued foreign outflows, plus the fading impact of RBI support measures, and you've literally got a perfect storm for currency weakness. Oh, and also worth noting, global gold demand actually rose 2% in the first quarter. That was driven largely by folks investing in bars and coins, clearly seeking a hedge against all these geopolitical tensions. Now, this is exactly where the global impacts the local. Crude oil jumped a massive 3.3% today to 9,800 rupees a barrel. And why does that matter to you? Because it immediately impacts local business margins. Take the oil marketing companies, for example. Because retail rates are still capped, these crazy elevated energy costs mean they are currently selling petrol at a loss of 14 rupees a liter. And diesel, they're selling that at a loss of 18 rupees a liter.
That is just staggering margin pressure, and it ripples right through all the import-heavy sectors of our economy. Meanwhile, institutional flows remained incredibly tight today. Foreign institutional investors, the FIIs, were net sellers once again, to the tune of over 2,100 crores. Domestic institutional investors did step in to buy, but the combined net inflows stood at just a meager 392 crore rupees. Bottom line, that foreign capital simply isn't providing the tailwind our market usually relies on right now. All right, Section 4, Corporate Earnings and News, the score card of the day. Let's pivot away from those macro clouds for a second and see how individual companies are actually navigating this environment. I have to say, I absolutely love this perspective. We got a direct quote today from Maruta Suzuki's chairman, R.C. Bhargava. When he was asked about market share, he essentially replied, "Why should I care?" He is making it super clear that he's prioritizing 100% capacity utilization and reasonable profitability over blindly chasing raw market share. It's just a fascinating look at strategic discipline in the auto manufacturing world, especially as they're bringing new lines online with capacities of 250,000 units a year. It's a real reminder to focus on the bottom line, not just the top line. And hey, speaking of profitability, we saw some massive earnings beats sweep across multiple sectors today. Vedanta delivered a completely stunning 89% year-over-year surge in profit, hitting 9,352 crore rupees. That was driven directly by those strong commodity prices we were just talking about. Adani Power also really flexed its muscles, with a 64% rise in net profit. And even looking over at the banking sector, Indian Bank and Federal Bank posted solid 5% and 22% profit growth, respectively. This really shows they've got healthier balance sheets and steady lending activity going, even with all those macro pressures weighing things down. Finally, Section 5, looking ahead, options data and tomorrow's setup. So, we've got defensive sector rotation, currency pressures, but strong corporate earnings. What does this all mean for tomorrow? The latest open interest data is basically mapping out our battleground for the days ahead. We're seeing heavy call writing, which means traders are betting the market won't rise any further, and that's building a massive wall of resistance right at those 24,400 to 24,500 levels. In a market that's already struggling to hold its afternoon highs, that buildup indicates some really strong overhead resistance. But on the flip side, put writers, the folks betting the market won't fall further, they've established a relatively firm floor of support down at 24,000. So we are currently boxed right into this 500-point range. And honestly, the options writers are just daring the index to try and break out of it. So keeping that heavy upper resistance we just talked about in mind and the fact that we clearly saw a flight to safety today, I want to leave you with this final question to ponder. Is today's shift into defensive sectors like FMCG just a temporary blip, a one-day rotation? Or is it a serious warning sign backed by that heavy options resistance, pointing to a prolonged struggle for the broader market? Think about it and let us know your thoughts in the comments. Thanks so much for joining us for this explainer. Keep your eyes on the data, stay sharp, and we will see you next time.